Yesterday's US inflation data gave us another piece of the puzzle. While headline inflation came down to 8.26%, that's only part of the picture, which is heavily driven by energy costs and food. In terms of core inflation, which is what the Fed prefers to look at in terms of the headline inflation report, that came in at 6.32%, which was significantly higher than expectations of 6.1% and higher again than the 5.9% recorded the month before. This illustrates that core inflation is rather sticky and is going to be very difficult to get under control. To put this into perspective, during the run up to the global financial crisis, US core inflation peaked at 2.5%. So we are currently seeing inflation in these most sticky of items at about 250% the level that it was before Lehman Brothers collapsed. So it's going to be quite tough to get under control. I went into a bit of detail on this in an article recently, which I'll include in a link in the description. Looking at the breakdown of inflation is really quite interesting because it shows that some of these distortionary factors, things like used cars, airfares, hotels, and car rental, are really starting to feed out of the data. They're no longer the significant factors that they once were. But even when you look at core inflation and then excluding those items, it shows inflation continuing to accelerate, which is something that's really going to worry the Fed and create some problems for markets going forward. One of the things that I've really been looking for in recent US CPI data and in particular PCE data, which stands for Personal Consumption Expenditure, which is another one of the Fed's preferred inflation metrics, is the rise in the cost of medical care, because it's actually been relatively low by US standards since the pandemic kicked off and the government provided all measure of subsidies, therefore taking some of the burden off of consumers. But now it's accelerated significantly and on a seasonally adjusted basis rose by 0.8% in August, which really bodes quite poorly for this particular form of inflation getting under control. Looking at the Atlanta Fed sticky CPI index, it shows a rise to 6.31%. Now, if you compare that with any time in the past 20 years, it's more than double. If you look at the trimmed mean for the Cleveland Fed's inflation index, that's at 7.22%, which is about double its global financial crisis high. The really interesting thing has been watching the reaction of the market. There was already fairly high levels of speculation that the Fed would raise rates by 0.75% at the end of September due to various leaks, various hawkish commentary by Powell and other Fed members. But what's really, really interesting is that now the market is considering the possibility of a 1% hike in September. At the time of this recording, it was priced in at a chance of 38%. But this is also having an impact all the way down the curve. Rather than the market starting to price in the Fed taking its foot off the rate hike gas late in Q2 next year, we are now seeing expectations that rates will continue to rise to about 4.5% in the second quarter of next year. So it's going to be really interesting to watch to see how these expectations evolve, because there is still, despite all these changes that have occurred, the expectation that the Fed will cut rates in the second half of next year. So despite the fact that Powell and other Fed members are saying that we are going to raise rates and they're going to stay high, the market still isn't believing them. So it's really going to be interesting to see how all this plays out. Thanks for watching. I hope you enjoyed this, and hopefully it wasn't too bad for the first time out of the gate.